Hello to everyone. Today I am going to start Corporate Restructuring Part 2. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel. Other structures like corporate governance structure, the collection of mechanisms, processes, and relations by which the corporations are controlled and directed. Governance structure and principles identify the distribution of rights and responsibility among different participants in the organization. In order to have the effective control, in order to meet law and regulation and policies and procedures, every organized organization develop different committees for the control and purpose, like audit committee, risk committee, etc. Now, such as the board of the directors, managers, shareholders, creditors, auditors, regulators, and other stakeholders, and include the rules and procedures for making decisions in the corporate affairs. Corporate governance is necessary because of possibility of conflict of interest between the shareholders, primarily between the shareholders and upper management or among shareholders, because management is also a part of, particularly directors, which are shareholders too and selected by shareholders as well. So a conflict may arise between them. What is corporate restructuring in finance? Corporate restructuring entails any fundamental change in a company's business or the financial structure designed to increase the company's value to the shareholders or creditors. The corporate restructuring takes place in two forms. First of all, financial restructuring, and other one is organizational restructuring. Financial restructuring may take place due to the drastic fall in the sales because of adverse economic conditions. Here the firm may change the equity pattern, cross-holding pattern, debt serving schedule, and equity holding. All this is done to sustain the profitability of the firm and to sustain in the market. So on one side, we have a financial max, that is a proportion that used to be decided as a part of capital equity and capital debt. On the other side, they take multiple measures to make the organization sustainable and profitable for the different situations. Other one is the organizational structure. The organizational structure means changing the structure of an organization, such as reducing the hierarchical levels, downsizing the employees, redesigning the job positions, changing the reporting relationship. This is done to cut the cost and pay off the outstanding debt to continue with the business operations in the same manner. The need for the corporate restructuring arises because of change in the company's ownership structure due to merger or takeover, adverse economic conditions, adverse changes in the business, such as bankruptcy or buyouts, overemployed personnel, lack of integration between the divisions, etc. Now, the regional accounts are developed for the companies before any type of merger or takeover. Residual accounts are basically the accounts that is developed on the fair position of the company based on its assets and liabilities. Common types of restructuring, first of all, merger and acquisition, integrating the administrative and the operational, technology and or products of two firms. Legal, change the legal structure of a firm such as the ownership structure. For example, a business may become its owner legal entity, its own legal entity. Third one is the financial, a change to a firm's capital structure such as the debt restructuring designed to allow the firm in financial distress to continue to operate. Thereafter, turnaround, restructure the administration, operations and products of an organization that is performing poorly. Often require new leadership, a change to strategy and the culture. So it's very common that you make necessary actions within the organization by turnaround. Thereafter, repositioning, a strategy designed to move a firm or a business unit to a new business or operational model. For example, a firm that sells software products that move to the software services model. So they either bring the innovation within the existing business or add some more models or replace with the relative other models. Thereafter, cost restructuring, cutting administrative and operational costs in response to a downturn or anticipated downturn in revenue or margin. Thereafter, de-investment, selling or closing a business unit that is unprofitable, non-strategic and problematic in some way. Spin-off, restructuring a business unit to be its own company while retaining some ownership. A spin-off is often done to seek a high valuation for attractive part of a business. Thank you very much. See you again with the upcoming video on corporate restructuring.